How banks actually create money. Fractional Reserve Explained. You might think banks simply store your money, keeping it safe until you need it. But what if I told you that the money you deposit doesn't just sit in a vault waiting for you? What if every time you deposit $1, the bank actually creates more money out of thin air? Welcome to the strange and powerful world of fractional reserve banking, the invisible system that quietly fuels our entire economy. The illusion of the vault? Most people believe that when they deposit $1,000 into their bank account, the bank locks it away, ready to hand it back anytime. That's not what really happens. In truth, banks keep only a fraction of your money, called reserves, and lend out the rest. This simple mechanism allows banks to multiply money throughout the economy. It's the financial version of a magic trick. Money appears, circulates, and grows without any new physical cash being printed. Think of it like a hall of mirrors. One real dollar is reflected again and again through loans and deposits, creating the illusion of far more money than actually exists. This system didn't appear overnight. It evolved over centuries, from goldsmiths lending more receipts for gold than they physically had, to today's banks creating digital credit that never touches paper. The birth of fractional reserve banking. To understand how this started, we travel back to the 17th century Europe. People stored gold with local goldsmiths for safekeeping. In return, they received paper receipts, early versions of banknotes, which could be traded instead of carrying heavy coins. Soon, goldsmiths noticed something interesting. Not everyone came to withdraw their gold at the same time. So they began lending out some of the gold, issuing extra receipts, and charging interest. As long as depositors didn't all demand their gold back simultaneously, the system worked, and profits rolled in. This was the birth of fractional reserve banking, keeping only a fraction of deposits in reserve while lending the rest to borrowers. Over time, governments formalized and regulated this practice, creating modern banks that operated on the same principle. The core idea hasn't changed. The money you think is sitting in your account has likely already been loaned to someone else. The money multiplier, how $1 becomes $10. Here's where the magic turns mathematical. Imagine you deposit $1,000 into your bank. If the reserve requirement is 10%, the bank must keep $100 in reserve and can lend out the remaining $900. That $900 is borrowed and spent, maybe on a new laptop. The seller of the laptop deposits that $900 into their bank. That bank keeps $90 in reserve and lends out $810. The process continues. $729, $656, $590. Each round slightly smaller than the last. By the time this repeats across the entire banking system, your original $1,000 has multiplied into $10,000 in total deposits circulating in the economy. No new physical money was printed. It was created entirely through loans, fueled by trust, accounting entries, and the expectation of repayment. Think of it like a ripple in a pond. You drop one stone, your deposit, and waves of new money spread outward, touching every corner of the economy. The modern twist: digital money and credit expansion. Today, this process doesn't involve stacks of cash changing hands. It happens almost entirely in digital form. When banks issue loans, they don't hand out physical money. They simply credit the borrower's account with a deposit, numbers typed into a computer. That digital balance is considered new money, instantly ready to be spent or transferred. In other words, banks create money when they issue loans. It sounds unbelievable, but central banks openly confirm it. The Bank of England once stated, "Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money." The catch? Every dollar created this way is backed by debt. Every new loan must be repaid with interest. That interest fuels economic growth, but also ensures that total debt keeps expanding. Our global economy, from mortgages to business investments, runs on this delicate balance of debt-based money creation. You could think of it like an engine that must always stay in motion. If lending stops, the economy slows, just as a car stalls without fuel. The central bank connection, the banker's bank. Commercial banks don't exist in isolation. They're connected to a central bank, the institution that acts as the lender of last resort. Central banks influence the entire system through monetary policy, setting interest rates, managing reserves, and buying or selling government bonds. When a central bank lowers interest rates, it becomes cheaper for commercial banks to borrow money. This encourages more lending, which in turn expands the money supply. Raise rates, and the opposite happens. Credit tightens, borrowing slows, and the money creation engine cools down. The central bank can't force banks to lend or people to borrow, but it can adjust the environment, like turning the thermostat up or down on the economy's temperature. It's an enormous power, shaping inflation, employment, and even the value of your currency, all by influencing how much new money private banks can create. The risk when the system breaks down. Fractional reserve banking works beautifully until it doesn't. The system depends entirely on trust. As long as people believe their money is safe, everything runs smoothly. But when that belief cracks, panic spreads fast. A bank run occurs when too many depositors demand their money back at the same time. Since the bank holds only a fraction in reserve, it quickly runs out of cash. It's like a theater with 1,000 tickets sold, but only 100 seats. As long as everyone doesn't show up at once, no one notices the shortage. But if they do, chaos. The Great Depression of the 1930s revealed this fragility. Lines of fearful customers outside banks, desperate to withdraw their savings, led to thousands of bank collapses. Governments responded with new protections, deposit insurance, and central bank guarantees, designed to restore confidence and stop the domino effect. Even in modern times, cracks reappear. The 2008 financial crisis was a brutal reminder. Banks had created vast amounts of money through risky mortgage lending and complex securities. When those debts collapsed, the money on their balance sheets evaporated. Central banks had to inject trillions of dollars in emergency liquidity to keep the system from collapsing. The illusion of infinite money met the reality of limited trust. The post-reserve era, money creation in the 21st century. Here's a surprising twist. In many countries today, the traditional reserve requirement barely exists. In 2020, the U.S. Federal Reserve set the reserve requirement ratio to 0% for most deposits. That means commercial banks can technically lend out all the money they receive, as long as they meet certain capital and liquidity standards. The modern financial system now runs less on physical reserves and more on regulatory confidence. Central banks control money creation not by limiting how much banks can lend, but by adjusting interest rates, asset purchases, and capital rules. In short, today's money isn't something tangible sitting in a vault. It's a web of digital promises, trust, and government backing. It's like a massive spreadsheet balancing loans, credits, and obligations, where the numbers themselves are the money. Critics and alternatives. Can we do better? Many economists have long criticized this system for being unstable and unequal. They argue that it rewards those closest to the source of new money, banks, corporations, and investors, while leaving others behind. Critics say fractional reserve banking encourages speculation, inflates asset bubbles, and amplifies crashes when trust disappears. Alternative ideas have emerged. Full reserve banking, where banks must keep 100% of deposits and can't create money through lending. Central bank digital currencies, CBDCs, where the government directly issues digital money to citizens. Decentralized cryptocurrencies like Bitcoin, which remove middlemen and operate on transparent blockchains. Each model carries its own trade-offs between innovation, stability, and control. But they all aim to make the act of money creation more transparent and less vulnerable to human greed or panic, the hidden engine of the economy. Despite its flaws, fractional reserve banking remains the hidden engine of modern civilization. It's the mechanism that allows businesses to start, homes to be built, and economies to grow. Without it, credit would vanish, and progress would grind to a halt. Yet it also means every boom carries the seed of a bust. The same system that multiplies wealth can just as easily magnify debt. Understanding how banks create money isn't just an academic exercise. It's a glimpse into the heart of the modern world. Because behind every dollar, euro, or rupee lies not gold or paper, but a promise. A digital IOU, backed by faith in a system that's part miracle, part illusion. The money we don't see. The truth is, most of the world's money doesn't exist in the way we imagine. It's not coins or bills, it's numbers on screens created by credit and trust. Fractional reserve banking has allowed humanity to build skyscrapers, fund wars, and connect continents, all through the act of lending what doesn't yet exist. It's a system built entirely on confidence. And as long as that confidence holds, the illusion stays real. But as technology reshapes finance and decentralized systems rise, a new question emerges. Should money be created by private banks for profit, or by society for everyone? Whatever the answer, one thing is certain: the next time you check your bank balance, remember, those numbers aren't just money, they're promises, circulating in a grand, global illusion that we've all agreed to believe in. If you enjoyed uncovering how banks actually create money, don't forget to like, share, and subscribe for more deep dives into the hidden systems that shape our world.